Hey, what up, everybody? Rhett Weaver here from Lifetime Home Loans. I wanted to wait until Friday to give you kind of the update as far as what's going on this week. We've had a lot of news over the last 2 weeks as far as inflation reports. There was another one today with the PCE inflation report. All these reports in the month of July have come in awesome, meaning they've come in lower than expectations with the federal government. Obviously, on Wednesday, we had the Fed raise the fund rate another 0.25%, but their comments were basically stating that they don't know if they're going to have to raise them again or not, which was really good. So we saw a positive reaction on interest rates that day. We've seen one again today, and we've seen it over the last 2 weeks. The issue was yesterday. Yesterday, the banking industry, and let me be very clear here, not the mortgage industry, not mortgages in general. I'm talking the banking industry. So, like America First is its own entity, Wells Fargo is its own entity. They're all their own companies that have to be profitable and have to lend money out and get interest back in order to be a profitable entity. And so the banking industry came out yesterday and basically stated that they have to tighten up the amount of reserves or liquidity that they have inside the banks because the media, social media, and the media in general, just like we saw banks fail earlier this year, the news travels so fast nowadays that the run on banks, and a run on bank means people go in to pull their cash back out, their deposits back out, are happening so fast because people have mobile apps that it's actually like very bad for the banking industry. Meaning we saw banks collapse or we saw banks fail because they didn't have enough liquidity inside of there. Let me go ahead and explain what the liquidity is or what that means. When you deposit $1,000, and we'll go over this a little bit more in detail. Hold tight with me. But when you deposit $1,000, they only have to hang on to $100 of the 1,000, and they can lend out 900. So the problem over the last 2, 3, 4 years is we got this PPI money, we got all this COVID money. There was a lot of deposits going into the banks. They went ahead and lent out 90% of all the deposits, for car loans or house loans or signatures lines or home equity lines or whatever that looks like. And then all of a sudden, that giant influx of money from the government stopped and people's income stayed the same. And now they went in to go take their money out in order to pay a lot of bills or pay a lot of things off. And the money or the liquidity wasn't there with each bank. And we'll go into detail on how to break this thing down just a little bit more. So when you kind of understand that, if the feds make the banks hold on to more money, so right now it's only 10%. If they come out and say, hey, it's 20%, 25%, whatever that is, we got to have that liquidity, we got to have that cash on hand. The issue is a bank is an entity. It has to make money. It has to be able to lend stuff out, collect interest, and be a profitable organization. And so what you're going to see is now they have to pass those costs off onto the consumer if they can't lend out as much money anymore. 90% of the deposits coming in. So the question is going to be is that the money that you have sitting in your bank account, are you going to get less of a return on that? Your CDs, are car loans going to go up? Are their mortgage rates at their particular places, meaning the bank's going to go up? Are those home equity lines going to go up? What's going to happen with signature lines, credit cards? What's going to happen in the banking industry to make sure that they can stay positive, have the liquidity, make sure they're staying profitable so they don't go out of business? And that's what we're going to have to see and find out. Well, yesterday, that really just blew up interest rates because that was a big piece of news that we weren't prepared for. Obviously, it's rebounded today with the PCE inflation report, which was really good. But I want to break this down just so you guys kind of understand, if you go and make a deposit at the bank, what they do with your money and how this kind of works. If you take a look at it here, obviously, if you just go in and put $1,000 into the bank, right now the reserve requirement is 10%, or they hold on to $100, and then they can take that $900 and they can go ahead and lend that out. Well, if I was going to go purchase a car for $900 and the bank lent that to me, then I go to the dealership and give them the $900. Well, the dealership then goes ahead and deposits the $900 at the bank, meaning the bank is now going to retain $90 but can lend out $810. Now they lend that out again. That particular person goes and buys something in the market. That particular business takes that money, re-puts it in the bank, the $810, $81 gets held, and then see how this whole cycle works. So that initial $1,000 deposited gets lent out multiple times, a lot, and you can probably do the math, but it's thousands of dollars based off that $1,000 deposit that banks are able to lend out on or leverage in order to gain a return with interest. And so this is what happened yesterday. So that news is just a knee-jerk reaction to who knows what's going to happen to the banking industry moving forward. And again, let me be very clear. This isn't the mortgage industry. This is banks and companies trying to be profitable. And what do they got to do to pass it on to the consumer to stay profitable and stay in business? One thing that I want to kind of show you here is really what's happening on in the market as far as the overview. If it's your first time here, when we take a look at this, green means interest rates are going lower, red means they're going higher. We are obviously still playing in these levels of resistance right now, trying to break through them, and we're having a hard time. We're just sitting here bouncing with all this different news. Obviously, this little green section here was all of that inflation report over the last 2 weeks. We had a couple other good news. Yesterday was really red and it bounced back a little. Today, we're really fighting that level of resistance with this PCE report. They're telling us to float still. They're telling us that things should get a little bit better here. Obviously, with the great news this whole month of July that inflation has come down, it's really good because moving forward, obviously, this is measured on a year over year aspect. And so we should see rates continue to fall like we have been telling everybody about going into the fall and the winter months. I think the month of August, we're going to just sit there and bounce and sit a little bit still. But once we get into the month of September moving forward, we should see some good stuff happens. Feel free to reach out. Hopefully that explanation made a lot of sense to you. But if you have any questions, feel free to reach out. Thanks.